Hey, it's Jim, and this is level 3 of the CFA program, a constructed response set on asset allocation. We'll cover the following learning outcome statements. We'll do some overview. We'll look at effective investment governance. And remember, inside of the learning module, the Institute gave us 3 levels of hierarchy. There was the governing investment committee, there was the investment staff, and then maybe some third-party resources. And then that was immediately followed by a whole list of tasks for effective governance models. And I don't know, there might have been like 7 or 8 or 9 of them in there, but the most important 2 are to establish short-term and long-term objectives, and then to allocate and identify the appropriate decision making. So we'll probably have to do a little bit of that here in this case study. We'll take a look at a balance sheet. That's just assets and liabilities. That should be okay. And then we'll go ahead and do our Harry Markowitz 2 questions at the end. How many times have you heard me say this? Remember, what we're trying to do is we're trying to push in this 2-space environment, right? Standard deviation on the horizontal axis, expected return on the vertical axis. We're trying to push our way back to that horizontal axis, and then we pivot and try to push our way up. Actually, the pivoting, kind of goes hand in hand with the pushing to the left. So we're trying to simultaneously, right? And this is almost an impossibility. And don't tell your finance professors I said this. We're trying to simultaneously minimize risk and maximize return. And then I love this last question here. I'm going to have a couple of things to say about it. We're going to have some choices of picking the appropriate asset allocation in that 2-dimensional space. And so that should be fun. So this is a pretty straightforward case study. So here we go. Wellspring pension fund. So we've got, several 100,000 members. We have a CEO reached out to us as an external consultant. What we're going to do is we're going to take a look at these, effective governance models. So what does this look like? They've got dedicated. Oh, there's a cool word in there. Dedicated means that, they're not relaxing and sitting on the beach, and et cetera, et cetera. So dedicated 7 trustees. Now, the interesting thing here is that 7, it might be the right number, but it might not be. If you get to a question on the exam and they say the pension fund has 627 board of trustees, you probably want to say that's too many. I'm not really sure how many is too many. 30 sounds like too many to me. 20 sounds like too many to me. We really don't have any fast and dedicated ideas about which boards are too big. But I think the Institute would, kind of make it a little bit obvious. 7 sounds a little bit low to me. So they bring valuable long-term experience in law and accounting. Well, that sounds great. It would be great if there were another sentence or 2 about what this experience brought to us. Accounting, of course, we need to know how to do balance sheet. We're going to do that here in just a little bit. But what kind of accounting? Is it accounting for nonprofits? Well, that probably doesn't help us. Is it just journal entry accounting? That might help us just a little bit. How about law? If it's contract law, that might be a good background, to see exactly what the contracts that we sign, derivative contracts, right? Option contracts, swap contracts. That's all important stuff. But it would be nice if there was another sentence that said, hey, of these 7 people, they know some law, they know some accounting, but they've served in the investment community for the past 5,000 years or something like that. So that's probably going to be something that we're going to talk about. We meet quarterly. The Institute tells us a lot about these kind of meetings. You don't want to meet daily. You don't want to meet weekly, but probably monthly or so. So that's probably a weakness in there. Let's see, 3 diligent. So go back up to we have dedicated board members and we have diligent junior analysts. So there, you see how we're trying to get the candidate to say, "Oh, dedicated and diligent. That sounds good." 3 junior analysts. So from my perspective, the diligent, that's a good word. I mean, right, these 3 junior analysts, you guys have probably been junior analysts at one time. Maybe some of you still are. You work pretty hard. So that's a good thing. But the junior, that's probably a more important word than the diligent in here. Let's see. Mark Chen leverages their collective expertise. So that's a good thing there. All right. So this dude, Mark, 20-year tenure, responsible for selecting external managers, specialized asset classes, ensuring fund benefits. Okay. So here's the current asset allocations. Notice that. What do you get? 45 and 25. So that's 70% equity, 20% fixed income securities, and then a little bit of an alternative investment, and then cash. What do we know about this? Unchanged for the past decade. Now, we don't have any idea what the past decade looks like inside of this case. But the past decade, the business cycle and the economic cycle and stock markets and bond markets, they probably haven't gone like this, right? They've probably gone like up and down, up and down. So there have been minor tactical adjustments based on his market outlook. And then there's a paragraph on some assets and liabilities. We'll come back to this slide when we have to do the balance sheet. All right, we're given a target return of 7%, maximum acceptable standard deviation of 11%. So those two numbers, clearly they link back to the policy statement, but Mark and the 7 dedicated or diligent, I forget which one was the board, those dedicated board members, they probably came up with those two numbers. And how did they do that? Well, we know this from level 1, level 2, and level 3, how you arrive at that 7 and 11%. So that's not part of this particular case. That could be questions in some other case. So look at domestic and international equities there. So expected returns, they're both above the 7%. So that's a good thing, right? But look at standard deviation, 19 and 21. So you should be slapping your head and thinking, okay, how can I, and let me go back here quickly. How can I have 70% of my investment in these two asset classes that, let's just take a quick average there. That's a 20% standard deviation. Let's just say, oh my gosh, that's almost double the acceptable standard deviation. So in order to come up with an asset allocation that's acceptable, we're going to have to throw lots and lots of fixed income in there. Look at the alternative investments, 25% standard deviation. I don't know if we can have any of that stuff. Probably a little bit, but. All right, so what we're doing is considering 3 approaches: risk parity approach. Remember that the risk parity approach kind of assigns an allocation based on parity or allocation, is that a word, to all of the risk factors or the asset classes, however you want to look at that. Increase allocation to alternative investments. Well, I think I kind of addressed that with the 25% standard deviation. Maybe a little bit, but probably not too much. And then liability-driven investment strategy. So here are the 3 potential asset allocations. So notice we've got purple, what is that, dark blue, and I don't even know what that color is over there. So X, Y, and Z. All right, notice that when you go from X over to Z, we decline in allocation to domestic, we decline in allocation to international, we increase our allocation to fixed income, and then we've got alternatives there, 5 or 10. Remember I said probably a little bit. So taking a quick look at these things. So option X, 7%, 7.8, option Y, 7.1. So they meet that minimum of 7%, right? Now option Z does not with the 6.3. But how about standard deviations? 14.5, well, that's way too high. Go all the way to Z, 9.5. Well, that's within that parameter, right? And then 11.8. So I'm going to say something about these when we get to that 4th question here. All right, so here are the questions. So let's identify 3 key issues of that investment governance structure, and then And this is important here. So for each issue, we need to recommend, we need to explain how it would improve the fund's asset allocation process. So we have to identify. So look at this. This is why we say 3 points. You got to do all 3. You got to identify, you recommend, and explain. Make sure you do all 3 of those. Second question is to go ahead and put together the balance sheet. So we're going to formulate that balance sheet. But then the second part is interpret 2 implications. So you get 2 points for the formulate, 2 points for the interpret. And then of the 3 approaches that I talked about just a minute ago, go ahead and tell us which one of those 3 that you think is the more appropriate. No, most appropriate. There's 3 of them, so not more, but most. And then look at the question, justify by providing 2 reasons. All right, let's keep track of those. And then which X, Y, or Z. So based on my kind of discussions earlier, we should be able to whiz through some of these or all of these answers here. All right, so what are we doing here? Identify 3 key issues. So let's go ahead and do that. Notice we've done this in bold. So lack of diversity and expertise on the board of trustees. So we'll probably talk about the law and the accounting in there. How are we going to make this recommendations? What should we do? Well, this gets back to what I was saying with the 7. 7 is probably not enough, so let's go ahead and appoint some additional trustees. Maybe 3, let's get it up to 10, although round numbers, they really don't mean anything more than 9 or 11. But I would recommend here, we don't do this in our answer key, but I would go ahead and say, 3 or 4, maybe even 5. And I would specifically state something like, hey, we want one person who's an expert in equities, one person who's an expert in fixed income, so that we can address systematic risk, so that we can address interest rate risk, we can address default risk. We can do all those kinds of things. So the Institute is very critical. They place a lot of importance on, expertise. That's important. And then diversity of those backgrounds so that, we all come together. What does the Institute use in one of those learning modules? The, kind of the holistic approach. That would probably be a good word to put in there. Second thing we don't like is this dude, Mark. He has way too much concentration of power. Has 3 of these. What was it? Diligent junior analyst. I would probably say something like, let's go ahead. Let's keep these 3. They're hardworking, right? But let's add a 4th. That might be somewhere between a junior analyst and a senior analyst, someone with, let's say, 6 or 8 years worth of experience. What does our answer key say in here somewhere? Something like, checks and balances. So if we appoint some extra board members who have great expertise, then what we can do is they can oversee Mark and the 3 diligent junior and then the extra mid-senior analyst, and this would be a great system of checks and balances. So notice we have checks and balances written in the answer key. That's probably important, and so that all adds to the asset allocation process. And then what did I say earlier? We don't want to meet daily, we don't want to meet weekly, but quarterly is probably not sufficient, especially considering that we're going to change the asset allocation. So if you go back to the learning module suggests, monthly, maybe even bi-monthly, maybe every 6 weeks. And I'm not sure if it matters what you say in terms of this answer, but if you say more frequent, what you could do is say something like, hey, we've got this board meeting, let's do it bi-monthly. But then, so now we're increasing up to 10 or 11 members. Maybe we have some subcommittees in there, and maybe 3 people over here that do the equities, the 3 people over here that do fixed income. Maybe those people can have a Zoom meeting, once a month inside of those other kinds of meetings. And so what that does is that just increases the information set. It increases communication. Remember, and even going back to the ethics stuff and professional standards, somewhere in there is there's a professional standard that says something like, let's just visit with each other. Let's talk to each other. Let's do all sorts of fun things. One thing that I forgot to mention back here is that if you, in this second one, and I'm guessing you guys are aware of this because I know that you listen to me in those recordings on learning modules. I tell you to read the Wall Street Journal all the time. But notice in here, there's this creates key person risk. Let me just remind you that key persons, chief executive officers, they get fired for two reasons. Pretty much incompetence, that's one. And it's okay, you read this in the Wall Street Journal, you know what, so-and-so, they stink at their job, so we're firing. But the other one is a violation of the terms of the contract. And that's probably, you guys read Wall Street Journal, you'll know CEOs get fired all the time for having inappropriate relationships. So, you don't have to talk about that kind of stuff, but that key person risk in there is important. So I failed to mention that just a minute ago, so I wanted to go back. All right, we finished that one. All right, here's the balance sheet. This is an obvious one here. I won't spend too much time. Two things. Make sure that you're aware that those prepaid expenses, those are assets. And then the contingency reserve, that's kind of like equity. Don't really think of it that way. So that goes over on the right-hand side of the balance sheet. So if you do the math, so the first part of this question is formulate the balance sheet. So you do all that stuff and you get economic net worth, and make sure you put a minus sign in front of that 180. And then of course, the second part of the question is, what are implications for the fund's asset allocation strategy? And so the first one, of course, is talk about that $180 million deficit. What this tells us, going back to, I won't go back to that slide, what did we have? 70% allocation to domestic and international equities, so that's probably just too aggressive. Pursuing too high returns, letting the second moment of the distribution, letting standard deviation, run rampant. It's kind of almost like anarchy. So what we need to do is that we need to manage that deficit, get our arms around it, right? Rein in the horse, so to speak, so that we can reduce that exposure to the anarchy of the equity markets. And when I say anarchy, I just mean that there's higher standard deviation. Now, somewhere in there was a $200 million loan that we were told was taken out for a recent shortfall. Oh boy, that's always a sign that things are not really too terribly good. So of course, you need to mention that this loan is going to have to be repaid. So this is going to put pressure on liquidity. And so look at the solution down there. So we want to invest in more liquid assets. Now, because we're this pension fund, of course, the liability-driven investment strategy, the one question that we have is, why haven't we been doing this all along? This is what the Institute has been teaching us for 1,000 years, right? You've got these liabilities over on the right-hand side of the balance sheet. So, of course, we need to match. So here's your chance to go ahead and talk about immunization, talk about duration, talk about convexity, all sorts of fun things down there. So C is the correct answer. So how are we justifying this? So we're matching the assets and liability. That makes sense. Ensuring liquidity and addressing the deficit. That makes sense. So what don't we like about risk parity? Well, what did I say earlier? That method assigns an allocation according to the risk. And so this kind of ignores the first moment of the distribution. So it may not be aggressive enough. It'll probably throw too much into fixed income. Why don't we like the increase to alternative investments? Well, I mentioned that before, right? We'll probably get some extra returns, but talk about anarchy in standard deviation. What was that standard deviation for alternatives was 25%. Yeah, that doesn't make any sense. So. All right, so the last thing is to go ahead and pick X, Y, and Z. So what are we going to do? Well, Z is out, right, because it doesn't meet the return objective. X is out because it far exceeds the standard deviation objective, and so we're kind of left with Y. Now, I want to make some editorial comments here. This is a really good case study because we're not given a perfect allocation. I seem to remember back in the old days when I was going through the program that there was a question. I don't know if I remember this as exact question on the exam or maybe it was just one of the prep questions that The Institute is not likely to give you, let's suppose there's an option W where it's consistent with both the risk and return objective, expected return and standard deviation. Maybe that would be 7.2% return and 10.9% standard deviation. That would be the ideal one. So if you get a hold of that one, then if there's a W, then go with that one. But in this case, we don't have the perfect one, so we have to make a little bit of a trade-off. In fact, I would probably make the argument that even if that standard deviation of 11.8%, clearly that exceeds the minimum acceptable return, but it's the most appropriate. The Institute is big on not what is the most accurate, what is perfectly accurate, what is the perfect ideal solution. The Institute always says most appropriate. So yeah, why is the most appropriate? All right, that was fun. Hopefully this gives you a good idea of asset allocation. I think this was our third one. Lots and lots of good stuff. So, hey, thanks for watching and good luck studying.